I am feeling great.
Cool, cool, cool. So sorry about the confusion this morning.
No, actually, it's my fault. Sorry.
Cool, cool, cool. So yeah, been since Dallas since I've seen you. So I'm excited to interview you because I know a lot of people from Utah and that neck of the woods. So it's really fun to get your questions. So I got
Yes.
I got a list of them, and I can go over those as well. But it's easier for just kind of communication, and if any more come up. So to start off, what was your first question there that you had? I can log on and
Yes. The big question for me is, do you project a crash is going to take place? And if so, like, what are some of the key factors that makes you think along those lines?
I think it's going to be a more, I don't think it's going to be a universal crash like 2008 was. I don't think it's going to be every market and from top to bottom. I think it's going to be a little bit more secular or market driven. Um, the places that I really see hard hit are number one, tourism. The tourism areas, like I live in Hawaii and I have a business that runs here in Hawaii. If I drive the streets of Hawaii right now, if I listen to what people are saying, nobody is out, the planes aren't flying here, and all of the airlines are projecting at least a 6-month period before they even consider raising their prices because they're trying to draw people back into the tourist industry. um, the cost of travel, the cost of flights, all of that stuff, because there's going to be an economic impact. I expect it to be at least a year before I really still see people start to travel. A year is way too long for people to sustain with their savings account, being able to pay their mortgage and all of those other things. So in the tourist driven areas, I do expect there to be a really sharp correction, an overcorrection. Um, I also see the oil rich industries having the same effect because tourism translates directly over into oil consumption. And so
Yeah.
I see the oil rich areas like West Texas, parts of Ohio, Pennsylvania, the Dakotas, those areas that are really reliant on oil as their main source of income. I see those places having a really sharp correction. I don't see the places that are necessarily tech strong areas, your Seattle's, Utah, even into like Kalispell, Montana, those areas where a lot of the people are transient or home stay-at-home workers already, where they're not going into the office. Their lives are largely going to be unchanged by this, and so I don't see those areas being super affected. I do expect a small correction in almost all markets across the US because over the next 2-3 months, not everybody's going to be able to make a mortgage payment. Not everybody's going to make a rent payment. Whatever the foreclosure time frame is, and I think it's going to stagger across the US. Like in Texas, there's a 28-day foreclosure process. It's really fast, the fastest in the union. In Utah, it's about 120 days. But in areas like Chicago, it takes at least 6 months. And so whenever that point is where they can start the foreclosure process, then I expect to see somewhat of a correction and a surplus inventory for a small period of time inside of those areas where there'll be some inventory and then the banks foreclose. So there'll be a bump, I believe, everywhere. But the areas that we'll see a crash, as you will, I expect them to be the tourist strong areas or the oil-based areas, but not universally.
Okay. So for your investors, with your information you just provided, what are the do's and don'ts at this point?
I wouldn't be buying a lot right now. Right now is a hold period for me. I'm watching the markets. I'm looking for that inventory, but knowing in the next 60 days to 6 months, there's going to be a surplus of inventory. That's when I'm going to buy. But right now, with such unknown on the future, because it could be a lot more drastic than I'm saying, but it might not be anything at all. There might not be a crash at all. But right now, I'm just observing. In my experience and watching the markets and watching what people do, the cost of being too bullish and too optimistic is a lot more drastic than the cost of missing out on a couple months of appreciation. So if I were to buy right now and need to sell in 6 months, if the market crashes, the risk to me is much greater than holding right now and missing out on 2, 3, 4% of appreciation. So I'm waiting right now. And that's what I would recommend to most people, unless that you're a big company with a fat payroll. In stocks and bonds and mutual funds and that market, there's a theory that they call dollar cost averaging, which means that you buy the exact amount of inventory during a specific period, regardless if the market does. And
Okay.
over time, it'll all level itself out and you'll see the same projection. There are people that can afford to do that in real estate, where every month or every week or every quarter or every year, they're buying the same amount of inventory regardless of where the market is. But you need to have a long enough projection on your investments where you don't need to sell in the process, and you can withstand that crash and just let time level out your trajectory. If you're not in that position where you don't have super fat payroll or super fat bank accounts, you need to sell during a specific period of time, then right now is not the time to move. It's the time to wait and watch and then make your advances. Once the unknown is over, we don't know where this goes economically. We don't know where it goes health-wise. We really don't know where this goes anywhere. So for me, I'm waiting. I see a lot of
So,
people that aren't, though. I see a lot of people
yeah,
that are
that is
still
so
moving.
true. That is so true. So, like, within this waiting period, like, how should we prepare? Should we focus on finances, building credit? What are a couple of things we can work on during this period?
Being liquid so that you can move when the time is,
Okay.
keeping your credit high. So if you are an investor
Mhm.
and you're wanting to borrow funds from institutions or even from hard money lenders, a lot of times they're credit driven. And so even though they're allowing forbearances and they're allowing all these other things with cars and houses, some of those still affect your credit. And so, or people are running up their credit cards right now.
Mhm.
If you want to make moves in the next 3 to 6 months, you can't have high debt income ratios, high utilization rates, and then miss payments and have that reflect negatively on your credit. You have to have high liquidity and high credit. So when the time is right, you can make moves. Um, Next, build network. Right now is a brilliant time to network. And that's one of the reasons why I'm doing these podcasts, right? Is because I'm offering value for free, which allows me to extend my network into other people that I wouldn't really have. And we all are sitting at home right now, or not everybody, but a large amount of the population is sitting at home right now. Rather than Netflix, rather than those type of things, networking activities where you can build your hard money lender base, you can build your bank lender base, because they're bored as well. They don't have the same volume they used to. They have
Mhm.
time on their hands. Those conversations, those events bring value to them, have conversations, share their name. But networking right now, I think, is one of the most important things you can do. So when the time is right, you have the network, you have the credit, you have the liquidity, you're ready to make moves. Next is to build those pipelines of however you're going to find that opportunity, whether it's pre-foreclosures, whether it's delinquent taxes, whether it's with banks and you want to build those relationships so when they have inventory, they'll call you instead of calling to list those. And that's usually the smaller banks, not your Fannies, Freddies, Chase. But building those relationships, I think, is really important right now.
Yeah, I absolutely agree. I didn't even really think of that. And I'm okay. So now this leads to my next question. So there are some hard-headed people out there, right, that have already started or have, a huge inventory and they don't know what to do
Yeah.
with people not being able to pay, their monthly rent. So what are your suggestions? What are some of the contingency plans we should have in place or get in place?
When I buy a rental property, especially a rental property, but when I buy a rental property, I have some really hard rules for myself. This isn't necessarily market rules, but these are for myself. And it's because when the market crashed before in 2006 to 2008, I built up a really strong portfolio. I wasn't paying attention to those people telling me to pump my brakes. And in fact, they would tell me that, and I'd almost scoff at them and be like, "Pump my brakes. The market's not crashing. Look at this crank." And I made more money last month than I've ever made before. So I was one of those hard-headed guys that wasn't looking at the signs on the market. And so I was also pulling a lot of cash out of my properties, and I was building up a monthly bill that was really high. So I needed to make a lot of money in a month to even make that happen. So for me, my contingency plans are once to live really lean. I don't like to have a lot of expense. The guys that are flexing, driving their expensive cars, showing their filet mignon dinners and their really expensive travels and all of those things, to me, that's a liability. It's not an asset. And so for me, especially in these times, I want to carve that down a lot. So I have as small of a monthly bill as I possibly can so I can withstand the storm. When everything's good, if you have a big bills, that's okay. You can make those. But in the storm, to withstand it, you have to have a savings account that can pay your monthly bills for a substantial period of time. And if you don't, trouble's on the horizon. So that's the first thing, is to trim your monthly expenses so that you can withstand a storm. Second, to build up your savings account. Debt is in my opinion, there is good debt and bad debt, but debt can be the enemy, or excuse me, but having no debt and having no savings is the enemy. So I have a savings account before I pay off my debt. I just had this conversation with a girl the other day, who's saying, when I get the stimulus money, I'm just going to pay off my credit cards. And I was saying, no, that's not the right decision to make right now, because that 1 or 2 months payment you're going to make on that credit card is not that big of a deal. You're going to lose 25, 30 bucks in payments to that credit card company to save on interest. But that $1,200 or 25, whatever you're getting on the stimulus money, sitting in a checking account, if this continues on for 3, 4, 5, 6, 10 months, having the ability to go buy groceries, to put gas in your car, to fund life is a lot more important than having no debt. And those credit cards will cut themselves off. If the banks say we are seeing an economic downturn, they will cut those payments off. So, or those credit cards off. So instead of paying down debt right now, save your money. Have a big savings account. Even if you have debt right now, you need to utilize your debt to income ratios or your utilization rates. If you have 100% utilization rates, your credit is going to be pretty much worthless. So you need to pay those down to the point where you have good utilization rates, but paying those off entirely and depleting your savings account is a bad move. Second, when I buy rental properties, especially rental properties, but my investment properties as well, I need to have enough equity to where the market can turn down and I can still liquidate my assets. In 2008, since I owed 100% of what my properties were worth, when I started not being able to make those mortgage payments when my tenants weren't paying me, I couldn't sell my properties. I was stuck with them. So being stuck with my properties meant that I couldn't access any equity in them, but I also couldn't stop the bleeding. I had the high monthly bill that I couldn't slow down because I couldn't liquidate those assets. So in my own business, I like to have 50% equity in every property, but my hard and fast rule that I will not break is 35% equity. It doesn't mean you have to buy a property with 35% equity, but I have to have enough money that I can put it down to where I pay down the equity to where I have a 35% equity position in every property. That way, market downturn, I can afford the 10% to my agents and I can still liquidate my property. Next hard and fast rule, I need to collect double my payables. If my payables are $500 a month, I need to collect $1,000 a month on that rental property. That means that property can stand on its own 2 legs. That's very conservative. I think you could get away with maybe even a 60 or 70%. When I see these guys that are owning a rental property and they're making $200 a month on it, statistics tell me that there's going to be 1 vacancy per year out of every property, 90% occupancy rate, which is pretty good, 94% occupancy rate, which means that I'm missing 1 month payment a year. If I'm only making $200 a month per house, that house is not standing on its own 2 legs on an annual basis. It is a liability. It's not an asset, which means it's reliant on my other business or on another property to even survive. So I've basically set up a stack of dominoes waiting for one to fall that will take down all the rest of them. So I need every property to stand on its own 2 legs. So I like to see double collectibles as payables. That's very conservative. I think you could get away with less than that, but I need every one of my properties to be profitable on an annual basis, which then leads me to the next, which I like to have 6 months saved for every property. So if I don't collect the payment for 6 months, I'm still good, which also allows me to fix the furnace, fix the water heater, repair the windows, or do any of those repairs to a property. Because once I become a slumlord, my occupancy rates decrease extremely quickly, which means I'm making less money, which makes that a liability as well. So having the ability to not be a slumlord and maintain a great relationship with my tenants means that I can withstand the storms. And it also means that people come to me when they're vacating their slumlords, when they're looking for a new place to live. If I have a good reputation in the community, people are like, hey, Josh maintains a nice property, let's go to him. And so it also helps to have enough in savings to where you can do the repairs and withstand the storm. So long-winded answer, but there's a lot of facets to it. So
Yeah, no, that's a great answer. So I'm more of a beginner investor, so I definitely appreciate that insight. And so I'm really curious, okay, when it comes to a deal, and I know there's different types of
yeah,
deals and things of that nature, but in a nutshell, like how can you lose money? I mean, you brought up a great point when it comes to at least 35% equity in a property. I did not know about even thinking about doing double payable in regards to rent, 6 months save. I just did not know that. Is there any other suggestions as to, or we want to make people aware of like how they can lose money on a deal?
yeah. So the two different flips or rentals, right? Those are kind of the
Okay.
two deals.
Okay.
Flips, you make your money when you buy. And that's kind of the adage that's out there that a lot of people spit out. Now, it's overemphasized in the seminar industry because they want to ingrain in your head that you make money when you buy, because then they're going to sell you something. So in the seminar space, they pound that into you make money when you buy, because tomorrow I'm going to sell you a $35,000 package. But in real estate, um, there is some truth to that. You do make money when you buy, but you lose money through the construction process. Most of the people that I see losing money on flips, they buy right, and then they hire the wrong contractors. They spend too much money on the remodel. They overbuild. They don't have a build plan when they first get into it, so they overspend, which means their margins get slimmer and slimmer and slimmer, so they lose money. Financing, I find, is one of the most important things in any deal, flip or rental property. High points, high interest rates leads to losing money if you don't move fast enough, or if the lender makes you sell during a downturn. So if I only have a 6-month note, market crashes in 4 months, and I have to sell in month 6, I am going to lose money on that deal. When instead, if I have financing that can wait 2, 3, 4, 5, 6, 10 years, even in one of the harshest crashes we've ever seen in 2008, if you could have held that property for 5 to 7 years, you're still going to come out in the positive. So if you have financing that will allow you to be flexible with your selling time frame, it's going to be hard to lose on a deal if you can go back and have a conversation with them and extend the projection for the property. If it's a flip and you can turn it into a rental property because your financing is such, or if your credit is high and you can then turn it into longer term financing, it's going to be hard to lose, because you can withstand that time and you can catch the appreciation and the correction on the upswing. In rental properties, it's most of the time what I see people do is not factor in all of the expenses of a rental property. They're factoring in mortgage and maybe taxes, and that's about all that they're factoring in. They're not factoring repairs. They're not factoring vacancy rates. They're not factoring evictions and all of those other expenses that come into rental property. So they're looking at it going, I make $300 a month while somebody is paying off my asset, which in 30-year theory is great. But if you can't withstand for 30 years, you're going to lose that property. So even though they're paying off your asset, if you can't hold it for 30 years, it's useless. So not factoring in all of the expenses and it making paper sense or accounting sense, but not practical sense in your life, is where I see a lot of people lose with rental properties. They're making $200 a month. They have a vacancy. They can't repair the property to put another tenant in. So then they can't remodel the property. They can't put a tenant in. So they wind up getting a horrible tenant that because their property is in disrepair, or they can't rent it out entirely. So now it's just a liability instead of being an asset. The mindset that every piece of real estate is an asset is a detriment. Every property is a liability before it comes an asset. It's only an asset if it makes you money. It's a liability if it loses you money. So
Oh, yeah. Okay. So, all right. That was a great answer. And okay, so I want to kind of build on that. You talked about funding. And so I feel like identifying like funding sources is tough.
it
You
is.
know, in my world, I just think bank and hard money lender, but I don't know anything else. So I'm curious to know, what are some reliable sources, and are the sources different if you're seasoned versus a new investor?
Yeah, private financing is probably one of the most underrated but most important places to look. I love private financing. So when I go into a deal, I like to speak to somebody and partner with somebody that's very like-minded with me and either borrow money. They can either be an equity partner or a debt partner, meaning I either have to pay the debt. So they're going to be 1 year, 6 months, they want monthly payments, all of those, or they're an equity partner where they share in the profits and losses with me, or a combination of both. So private financing is important. Build those relationships with people that have 401ks, IRAs. They have the assets that they can lend that would otherwise be stagnant, and they want to put it into an intangible asset. So looking for those people that have some liquidity and some net worth that could partner with you on a deal and want to get into the real estate space. They have the money, they don't have the time or the knowledge. You have the time and knowledge, so you come together to form a deal with those people. So private financing is one of the most important. But where I've most of my hold properties and where I get a lot of my properties are through seller financing or subject to financing, where the seller is in a desperate state. And I don't want to be predatory. That's one of my hard and fast rules, is I can't be predatory with my sellers or with the property owners. But I find a lot of my properties through distress. So I'm looking for those people that are behind on their mortgage payments. They're behind on taxes. They have And if they have multiple stressors, if they're behind on their taxes and they're behind on their mortgage payments and they have lawsuits against them, I know they're in a really bad economical state. So I can step in, sit down with them, and solve their problems by taking their property off their hands. That becomes my debt responsibility, putting a couple of $1,000s in their pocket so maybe they can pay off some other bad debt, or they can just give themselves some breathing room, move into less expensive housing options, or get some state help. And then they carry the note on that property. They probably have an underlying bank that has a mortgage on that property, so it would be what we call a subject to if they already have an underlying mortgage. But using that as a funding source means that I don't have to come in with as much money. I can step into a profitable state, but I can also help that person out that needs some of that help in their life. It's really important not to be predatory. If I start taking advantage of people and knowing that they're desperate for $1,000 now, but knowing I'm screwing them in the long term, that's not a good move. It's not a good look. It will come back to bite you in the ass later on. So it's important to really do what's best for them. But a lot of the properties I'm buying are through that. It's also important to build your network in that same situation, because you'll knock on a door of somebody that's behind on taxes, or they're behind on their mortgage. And sometimes seller financing or subject to isn't their best option, or they have other problems that need sorted out before then. Knowing a real estate agent that can handle a short sale for you, knowing an attorney that can handle a bankruptcy for your clients. So networking with those other people in the industry. So you knock on a door and they say, hey, I've got 7 car notes and 6 credit card bills and I can't pay my mortgage or debt because they're taking my money before then. Cool. Let me refer you over to my attorney. He can handle a bankruptcy for you. I trust him. He's not predatory. So they can handle that phone call just by filing a bankruptcy. It eliminates all of that other debt. Or maybe there's a lawsuit on them that's in lien position on the property, so they can't sell or finance it, and they need an attorney to either represent them in that lawsuit, or to file a bankruptcy to eliminate that. And then once the bankruptcy discharges, then they could sell or finance the deal. So having attorneys, short sell agents, those people that are knowledgeable in this industry, so that you can refer those people and solve whatever problem they have. Real estate will be one of your bonuses to that. But also having those networks, sometimes they'll bring you deals. They'll come back and say, Arian, we have a client that we're filing bankruptcy for, but they need to get rid of their property. Are you interested? So there will be a reciprocation by having that network and those people in your network.
Okay, so all right. Now, I do understand network is important, and it can be tough sometimes
Yeah.
to like barter those type of services. As I think as a new investor, because I feel like I don't know anything. So I'm curious to know, like what type of, I know you said time and
Uh-huh.
knowledge, right? As a new investor, if I'm going the private financing route, that could be like a competitive edge or advantage. Um, so I'm curious to know, what are other competitive advantages for young investors? And then what are also some competitive advantages in the market once we wait out this 6 months?
Um, the first thing that I know that most young investors do, or beginner investors do, is they ask before they provide. They ask for money before they provide value. And I see it all over the place. I see people always coming in hard with wanting money before they provide any value. So provide value before you ask for money. Whether it's it's just knowledge or time or whatever that advantage is, and especially in the business world, bring value to that individual. If they're an attorney, provide them with clients. If they're a lender, provide them with other borrowers. If they're whoever they are, whatever they're looking for, bring them value first. So that's the first thing. And value sometimes can be as little as regular heartfelt conversation. It can be that what's the word I'm looking for, that elementary, that it doesn't have to be something grandiose that you're bringing to them, but bring value to somebody before you ask them for something. That's the biggest competitive advantage that I see that most people have, is building a relationship, doing what's best for them, and bringing them value. So so in a marketplace, the competitive advantage of a marketplace, and especially you guys there in Texas, you guys bring um a kind of steady calm to most marketplaces. When you look at the three big cities in Texas, Austin, San Antonio, and Dallas Fort Worth, and you can include Houston in that, but Houston's a little more volatile, but those three areas are not as volatile as the rest of the market. So if you want to see just a steady 3 to 5% climb, not a 30% drop and 40% rise that you'll see in a lot of places like Oklahoma or Indiana or Illinois, if you want to see just a steady climb, Dallas, Fort Worth, San Antonio, Austin, those are kind of your places for that. You guys have ranching, old money, entertainment, travel, oil. You guys have such a vast array of market, of economic stability, that you guys don't see these sharp moves. And so if I want to put my money somewhere where it's really safe, Texas would be one of my first looks. Now, if you move out towards West Texas, Lubbock, Big Springs, Odessa, those areas there, that's where you see the volatility. I mean, they're crashing right now. They're plummeting. And so if you wanted to get in and take advantage of some correction, that's where you could also speak to investors and say, hey, if you want a 3-year play, let's buy in Odessa, put a tenant in, we have a 5-year exit strategy because it's crashing right now. And I get text messages from a wholesaler that's out in that whole area, and he just sent me properties that were $80,000 6 months ago that are now $30,000 and $40,000 because all of the oil workers are leaving. And so these areas are just crashing. I haven't been to that area in a long time, but I bet if you went to Big Spring or Lubbock or any of those areas, I bet there are 2 cars in all the parking lots, in all the hotel parking lots. Because the oil workers that rent those places aren't there anymore. So as those places crash, you can buy and then liquidate in 5 years. So having that business plan developed. So when you go to your investors and you can say, this is my market data. I've looked 20 years in the past, and this is what I've seen. We're on the downward trend now. Let's buy now. And the trajectory is in the next 5 years when we're going to be able to sell. I think that's a competitive advantage that you can have personally and in marketplaces, is to study and know your marketplace. So you know exactly what you're dealing with. So when you see the crash, you know what the recovery looks like. When you see the recovery, you know what the crash looks like. Right now, when you have time, even if Netflix is playing in the background, do some research and find out what the last 20 or 30 or 40 or 50 years are in your marketplace. And that's something that I spend a lot of time studying, is what have all the crashes looked like? What have all the recoveries looked like? When have they been? What has caused them? And that's one of the reasons why when I look at today's market crash, I don't see it like the 2008 market crash. But I see it different than a lot of other real estate investors are. A lot of real estate investors, I see all these charts and graphs that are telling you when markets crash, 3 out of the 5 have not affected real estate. We've seen growth. Yes, agreed. However, 3 of the 5 recessions or crashes have been market or stock recessions, not necessarily unemployment recessions. If you look at the crash in the 70s or 87 or the dot-com bubble, those weren't economic crashes necessarily. They weren't unemployment. You weren't seeing 25 unemployment rates nationwide. You were seeing still the same unemployment. Being from Utah, when the dot-com bubble happened in 2000-ish, in Utah, we barely even felt it. If your IRA wasn't rocked and you didn't need that money, you didn't even know. I didn't even know that it was affecting the markets. Where in Silicon Valley, people were killing themselves on a daily basis because they couldn't pay their debt. And in Silicon Valley, markets were crashing because it was so secular. So I think this is going to be kind of a blend of the market crashes of the 87s or the 2000s when they were stock crashes that didn't affect the blue collar workers, which in turn didn't necessarily affect real estate crashes, and that of 2008 where it was caused by real estate. I think that this will be a blend of the two where you're going to see a little bof both happen. So, but understanding the markets and the trajectories and the crashes and everything else gives you a competitive advantage all of those other people that are just charging forward, or the ones that are doing nothing. When you are moving according to factual knowledge of history and projected future, that will give you both a market advantage and a personal advantage over all the other people out there.
No, this is great. I really appreciate the value and your input. Okay, so my last question
Yeah.
is, I'm curious to know, how can we continuously learn more, and where are some great places to find like more of your perspective?
So I am right now, because everybody's hurting for money. Right now, I'm trying to put as much value out there without asking for any money. So even my Patreon and everything else, I've canceled all. I still have Patreon, but I'm not charging anybody. I've paused all billing for however long that's going to happen for. And so I would look for the guys that are willing to just bring value for free right now, that aren't going to ask for your money. Whenever there's a hard ask with value, I shy away from that a lot of times. If it's a little bit of money, because everybody's time is worth something. So if it's a little bit of money, I'm willing to do that. But the guys that are coming and hitting me with $1,000 a month, $10,000 a month, I want to see that they're going to bring me more value than what it's going to cost. I stay away from those hard and fast seminars that in 3 days, they're going to try and ram everything down your throat. Real estate is a long-term play, and markets change so quickly and so often that if you're getting all of your value in a 3-day period of time, in 6 months, it could be useless. So I like to have anything that I'm paying for value spread out over a long period of time. So whether it's $100 a month, $20 a month, spread out so that I can get that value as market changes. I'm doing a free event on Sunday, and hopefully I'm able to do it every Sunday, where as many people can jump on as they can. And I'm going to try to put together a team of the people that I know and trust: the attorneys, the hard money lenders, the guys with money, the real estate agents, inspectors, appraisers. It's kind of short notice for a lot of these guys. I've got a couple of people committed for Sunday, but every Sunday I'm going to have people on, and I want those people to have off the record conversations with everybody joining, to where that network can really grow and they can make money where I don't take a piece and nobody else takes a piece. It's just building relationships. Partner with people that are willing to be either equity or debt or knowledge partners, where they're bringing something to the table. If all that they're doing is asking for your money, they're not necessarily the guy that I think is for you. Make sure that they're going to bring value to you before they ask for any money. And right now, we're an information age, and there are a lot of websites out there. There are a lot of people out there. One of the guys that, and I'll have to say, and when he first came out, I was like, man, what's this guy's play? It's Gary V. I don't know if you know Gary Vaynerchuk.
Yes.
A lot of my generation doesn't know who Gary Vaynerchuk is. A lot of the 35, 40, and those older have no clue who the guy is. He brings constant value. He is harsh. He's brash. A lot of people might not agree with what he says. Great. He's willing to give it all for free because he knows that it'll pay him back in some other way. I at first I didn't love Gary Vaynerchuk. He's really grown on me. He brings value, and he doesn't ever ask. I never see him go, click here and pay me for something. You know, it's a constant supply of information. More and more guys are following his lead, and maybe it's not his lead, maybe they're just figuring it out on their own, but more and more people are willing to give that information, knowing that it'll pay in the long future. So people that are willing to give information, give value, play in the game, in the long game, and making their money in the long term, that's who I'm looking for right now in my business. It's the attorneys that'll spend a half hour on the phone with me talking about things, not expecting to bill me hourly. It's the doctors that I can call and ask about this coronavirus and COVID that I know they're not getting paid for that. And I know when they are on the clock, they're making $300, $400 an hour, but they'll spend an hour of valuable time with me just so I can personally understand it without it being of immediate value to them. And that holds true for attorneys, hard money lenders. There's a guy that I'm going to have on Sunday. His name's Maine. I just saw him post on Facebook. He's been day trading in stocks. And his thing was, hey, any of you guys that want information, he's made $10,000 over 3 days just by day trading calls, puts, making money on margins. And he says, anybody that wants information, hit me up and I'm willing to give it all to you for free. And I hit him up and said, is this something you're trying to scale? And he goes, no, man, I don't want to scale this. I'll just help people out. Those are the guys that I really want to build time with and value with, is the guys that are willing to give it all for free. And especially right now when everybody's hurting, nobody needs them billing you right now when everybody's going, I'm unemployed and I'm looking for my stimulus check and I'm not going to get money for 6 months. The guys that you want are the guys that are going, hey, let me see if I can help lessen this burden a little bit for you rather than adding to your burden. So long-winded answer again.
Yeah, no, it was great. Thank you so much. Thank you for providing your perspective and your willingness to help others. It's absolutely great. We need it. So thank you so much for this opportunity.
Not a problem. Thanks, Arian. And join us on Sunday. So
yeah, I'll be there.
All right, perfect. Sounds good. It's on my Facebook page. There's a link to it, and I'll throw it out again so you can see it. If you're my friend on Facebook, I don't know if you are or not.
I'm on Instagram. We're friends on Instagram, but I'll find you on Facebook.
Okay, I'm going to put the link in my bio on Instagram. Don't sweat it. If you're not an Instagram girl, don't sweat it. I'll put the link in my bio on Instagram today. And so you can just follow the link in my bio and that'll take you right to the podcast on.
Okay. Yeah, that'd be great.
All right. Perfect. Sounds great.
Thank you.
Thank you.
Have a great one. Be safe.
You too. Talk to you soon.
Bye.
Bye-bye.